All right, welcome back for the second video lecture on transfer pricing. So during the first video lecture, we really just went high level. What is transfer pricing? Uh, and kind of one example of how you could see it happen between divisions. So now we're going to get into the different types of transfer prices that exist. And there's three main prices that are used in practice, and it's market-based, cost-based, and negotiated transfer prices. So the rest of this lecture, we're going to go through and talk about these three different prices, kind of just high level um, when they're beneficial. And so market-based is exactly like it sounds. It's the price that somebody would charge on the open market. So if Division 1 is selling to Division 2, and Division 2, say they're selling tires, like in our last lecture, if Division 2 can go buy the tires on the open market for $5, well, then that's what Division 1 should charge Division 2 is $5, whatever the open market rate. Of course, this assumes that there's similar products or services publicly available and that it has to be perfectly competitive. That it has to be something like tires or oil and gas, or it can't be something unique to the firm or that doesn't really have a very solid market rate. And of course, we have to make sure that there's no additional costs or benefits of buying within the company. For example, if tires you buy outside, they cost $5, but it takes 2 weeks to get them, and that slows down the process. So maybe we can charge. So if the tires from Division 1 to Division 2 only take 1 week, well, then maybe we don't use market rate. Maybe we look for something else because now there's a big benefit to using internal prices or to using an internal transfer because we get it faster. So maybe we can work on that price in a different way now. So we just always want to make sure that we think about these other costs and benefits if there is some sort of cost and benefit from buying inside the firm to transacting externally. But if there's not, if there aren't any additional costs or benefit, and it's a completely competitive market for this product, then we should always use market-based transfer prices because that really will force Division 1 and Division 2 to make the best decisions, knowing that there's this competitive market out there. So another thing we can use is variable and full cost. Variable cost just says, hey, we're going to charge our variable cost to the other division. And this just encourages really good decision making. Of course, this assumes that if Division 1 is selling to Division 2, if they sell at their variable cost, we have to acknowledge that Division 1 is not going to make a profit, right? They're selling at their variable costs, so it's going to be variable costs plus fixed costs are their total costs. So if they sell at variable costs, this will go away, but they'll still have their fixed costs. So in general, Division 1 is going to operate in a net deficit. So really, this helps the company overall, and it makes Division 2 look really good. So this is what you use if uh, you're not worried about a division needing to make a profit. If you're okay with this division just being a loss center or a cost center, and Division 2 really being the profit center. And then the last cost is full cost. And this is really easy. This just says Division 1 is going to make zero profit, zero loss. They're going to just charge all their costs to Division 2. So it's easy and it's what you should use for tax purposes. But the problem is that fixed costs can be irrelevant for a lot of decisions. So if Division 1 is charging all those fixed costs to Division 2, and division 2 finds it cheaper somewhere else. So say variable costs plus fixed costs are $5, and division 2 can buy it for $4.50. It's going to look like division 2 should go on the open market and buy it. So now division 1, they won't be selling anything, but they'll still have their fixed costs. So assume the variable cost was $1 and the fixed costs were $4. Well, they still want to cover these fixed costs. They're going to pay those $4 no matter what. So they would have rather charged just $1, or they would have rather charged $4 just to cover the fixed costs to division 2, and it would have been better for the firm overall because they're going to eat these $4 anywhere. So that's the problem, is fixed costs. Sometimes those sunk costs are irrelevant. So in general, you can use either cost method. The first one needs to acknowledge that division 1 is going to operate at a loss. Using full costing, you have to acknowledge that division 1 is going to have zero income and zero loss, but have to be careful that fixed costs are properly incorporated and don't lead to bad decision making. The next price option is negotiated. So in lecture 1, we had a problem where the variable costs for division 1 were $90. The cost for division 2 to buy outside the firm was $150. So we said the proper sales price is somewhere that's greater than $90 but less than $150. Because as long as it's over 90, division 1's happy to sell it. As long as it's under 150, division 2 is happy to buy it. So what we can do in this instance is let these two division managers get together and they negotiate. And hopefully they do something like, say, in 120, so they both get $30. So they kind of split the difference. So we just let them negotiate. And this is a great way to do it. And really, it's similar to if they went outside the firm, where you have to negotiate with your suppliers and your customers on these prices. The bad part is we're all in it together. We're all in one firm. And if these negotiations become too extreme, it can really hurt the firm morale. Say Division 2 is just a big, powerful division with uh, executive in that division that's super aggressive and a great negotiator, and they come in and they argue and they want it for $95 no matter what. Well, that might hurt Division 1, right? They're only getting a $5 increase, and Division 2 is saving $55. So Division 2 is going to look really good, Division 1 not so much, and that's all because one really bullied the other. And this can also happen just because one division is larger and more powerful. In this instance, it was Division 2. Or it could be that they're just better negotiators. And we wouldn't want one division to suffer just because they got bullied by a different manager or a different division. So if this is happening where it's hurting morale, it's making the divisions ultra competitive, it might be time for the corporate to step in and set this at something like $120. Help them with the negotiations, do something that's very fair. So this is for you guys to review. It's just kind of a summary of what we talked about, kind of the strengths, weaknesses, if it achieves goal congruence, if it motivates managers, it's useful for evaluating, and some other factors. I would just read through these. They're pretty straightforward, but definitely something worth reading through. Okay, so our last example, this gets to a very important thing in a second that says what is the minimum transfer price. And when thinking about that, let's assume that we're Uber drivers, or you're an Uber driver, and I need a ride to the airport. I find out that your variable costs for the trip are $8. And I say, hey, I'll give you $8.01. and I know that you have excess capacity and or that your variable costs are $8, and so I say I'll give you $8.01, thinking, well, you're going to make contribution margin of 1 cent. That's positive. You should take the deal, right? Would you take me to the airport for $8.01? We've talked in the past where anytime you have a positive contribution margin, it's a good thing. But in this instance, you need to think about opportunity costs. Sure, we've learned about opportunity costs, and we've learned that you should always do positive contribution margin transfer or projects. But when you're driving me to the airport and driving all the way back, sure, you made a cent, but you could have been giving people rides all around town. And so you would have had this other opportunity that you could have made more money. And this is the same thing with minimum transfer prices. When Division 1 sells to Division 2, it needs to be at a price, a minimum transfer price, that is their variable costs plus opportunity costs. If it's just their variable costs and they could have sold this to an external market for, say, $1 more, then they really need to add in, well, we could have made $1 had we sold it somewhere else. So that extra dollar to an external customer is an opportunity cost. So if their variable costs are $5, if they sold it outside the firm, they could have made an additional dollar. Then they should really sell it to Division 2 for a minimum of $6. If they don't do that, then overall the better decision would have been to sell it outside the firm. And here we have to be careful. It's incremental costs because it's also, you have to incorporate, it's your variable costs plus additional costs of producing and transferring the products. And then obviously opportunity cost is the maximum contribution margin you're giving up. So that's that extra dollar that they could have made if they would have sold it outside. So this is very important. Make sure you 100% know this formula. Minimum transfer price is the incremental cost incurred. So this is variable cost plus any other cost to transfer it, plus the opportunity cost that you're giving up by selling it to the other division, other subunit. That is a very important thing to consider when determining transfer prices. So this last alternative, it's something worth going over because in theory, it's a really cool idea. But we'll see why I can't imagine that a lot. I didn't see it in practice, but I didn't deal with alternative or transfer pricing a lot in practice. But what this says is we have our Division 1 and our Division 2, and we want to sell from Division 1 to Division 2 internally at a transfer price. Well, what we could do is Division 1 on their books, they say that they sold it for $10 because, say, that's what they could do in the external market. And then Division 2 on their books, they say they bought it at $8 because that's some cost and some profit that they need. They need to make this extra $2 profit, so they reduce the cost by $2. And then at the corporate level, we have an account that reconciles these amounts. So we essentially have three sets of books. Division 1 has their set of books that show $10 in the transfer price. Division 2 has their set of books that shows $8 in the transfer price. And then we have a corporate set of books in the middle that is just reconciling these in special accounts. And what this can do is you can really set up that have Division 1 do what's good for them, assuming this $10 transfer price. Have Division 2, you're incentivizing them to do what's beneficial for Division 2, assuming this $8 transfer price. So it's a good way to incorporate these things into a reward system, right? We really want Division 1 and Division 2 to get along. We want them to buy and sell from each other. So, hey, let's make it the best for them by allowing them to have their own sets of books. And at a corporate level, we'll tell them, Division One, you're going to sell at $10. Division Two, you're going to buy at $8, and we'll reconcile the difference. Another way that you can encourage internal transfer prices, not necessarily by using this, but this is just something worth noting, is you can make, if you want to encourage Division Two to buy from Division One, we can, at a good price, we can say, hey, Division Two manager, your bonus depends on Division One's profits, right? So now they're willing to give Division One a really good price, or a really good sales price, because Division One's profits help them. So using this dual transfer pricing and incorporating some of these things into the reward systems can really help the different divisions work together. The bad part about using a dual transfer pricing system, like we said, it requires 3 sets of books. And that's a lot for a company. Imagine you have 50 divisions and they're all transferring at these different prices. You'd end up having hundreds of sets of books, right? One for each division and one that's reconciling each division's purchase and transfer from the other divisions. So it could get very complicated. And I think that's why I've never seen this in practice. And I just can't imagine that it'd be worth it for a company, unless maybe they only had 2 divisions, worth it for a company to have all these extra accounts and sets of books. But these down here, other ways to encourage internal transfer prices, building it into reward systems, having the manager's bonus depend on their supply and customer divisions. Those are really interesting ways that can incorporate and incentivize transfers and giving each other, and when I say each other, the different divisions, really good pricing with each other. So hopefully that makes sense, that we really always want to encourage transfer prices between our transferring goods between our division, because overall that'll help our firm. Um, and one way we can do it is with these dual books, but it's probably, or the dual transfer prices, but it's probably not that reasonable for most firms. So here's a problem for you guys to work through. As always, the answers will be posted in the slides. And so far, we've looked an overview of what transfer prices are, and we've went through the various types of transfer prices a firms can use. The next lecture, we'll discuss global transfer prices and specifically what firms do right now and what firms can do to save taxes, to transfer goods from one country to another at these unique transfer prices to try to save on tax. So that next one is pretty interesting. I'm excited about that lecture. So I'll see you in our third lecture for transfer.